I'd like to welcome everyone to today's LISA PodiumX series discussion. The Lead Incubator and Startup Accelerator, or LISA, was founded by Stanford lead participants for the lead community. It's a hybrid platform for both incubating ideas to MVP, as well as then scaling those ventures globally. The PodiumX series is designed within LISA to focus on leaders, venture capital, various industries, thought leadership, emerging tech, and products. My name is Edward Munt. I am a founding partner at LISA. The rest of our group includes, joining us today, Deepti Pala, who's based in Switzerland, Hira Dangle, who's in the Bay Area. Misha Baikov is not with us today. He's also based in Silicon Valley, as well as Joe Anthony, who's located in Sydney, Australia. I would like to thank each one of you, today's guests, as well as Stanford GSB lead and rebuild team members for supporting today's event. Today's panel discussion is focused on investing in MVPs. What is the venture capital's investment thesis for initial, pre-revenue, and scalable ventures? Founders are backed by investors in all phases of their company's building process, from idea to MVP, exit, the IPO, in current, new, and niche markets. We're very fortunate to have such amazing guests today. Let me introduce Andrew Romans, CEO and General Partner at 7BC Venture Capitalists, Rohini Chakravarti, Partner at NGP Capital, Chad Anderson, Managing Partner at Space Capital, and Mohammed Islam, Partner at Threshold Ventures. Now I will turn things over to author, keynote speaker, and former Stanford lecturer, J.D. Schramm, to start the discussion. J.D., thank you.
Excellent. Edward, thank you so much for the introduction, and thanks to all of the organizers for getting us together and on time for a 9 o'clock start today. I am looking forward to this conversation greatly. I was honored when they asked me to lead this, and I think you want to hear more from the panelists than you do from the faculty members. So what we have asked each of the panelists to do is just to do a brief 2 to 3 minute introduction of her or his current work. And panelists, what I'd love to have you do is paint a little bit of your journey, what it took for you to get to where you are today. And we will just start, since he was the first one on the call this morning, start off with Chad.
Sure, thanks. Hi, everyone. Am I still coming through okay? Okay, great. So yeah, I'm managing partner of Space Capital. We lead rounds in seed stage companies, focused on founders who are leveraging space technologies such as GPS, geospatial intelligence, and communications. So we are a space-focused fund, but for us, space is much more than just rockets and satellites. Primarily, it's the data that comes from satellites and enables, our global economy. So a little bit of context, what's going on in the space economy right now is quite interesting, and there's a lot of enthusiasm. But 8 years ago, when I started this, there wasn't a whole lot going on. And really, a decade ago, there wasn't much entrepreneurial activity or investment to speak of. So SpaceX removed the barriers to entry 10 years ago. Took a little while for things to get going, and pretty much over the last 5 years or so, we've seen most of the growth. So we've been around for all of that. Founded Space Angels, which was an SPV fund. We were doing them deal by deal, which is, that was the available deal flow and investment at the time. Investment capacity at the time. So pulled it together deal by deal, raised our first institutional fund in 2017. We're just deploying the last capital out of that in initial checks now, and we'll be launching our second institutional fund in Q3. So yeah, kind of been at the forefront of this sector, been leading the charge, and it's really, we built a really great foundation. now to ride this incredible wave of enthusiasm and activity that's happening.
Excellent, Chad. Thanks. I was excited to see we had space technology represented when we were talking about minimum viable products. So I'm interested to have that
Sure.
conversation in a minute. But right now, Rohini, if you would do your introduction as well.
Sure. Very happy to be here. And I am dialing in from Palo Alto, just to let people know on the chat, all these exotic places there. So my background is that I've been a venture investor for almost 20 years. I right now I'm a partner at NGP Capital. We're a global firm. We invest in 3 areas: mobile 5G. Anything that is a co-traveler with the 5G and edge technologies going along with these mobile rollouts, as well as applications like robotics and AI that's around these new technologies. The second area is enterprise, where we invest in SaaS as well as security. And the third area is smart mobility, which is smart transportation and logistics. So everything from ride sharing to grocery delivery and things like that. So those are the 3 areas. We have about $1 billion of assets under management. We're a little later stage than maybe some of the other participants here. We tend to invest, I like to say at least post-product, ideally post-product market fit, right? So depending on the space, that could mean that we want to see some unit economics, or in other spaces, we actually want to see proof of customer traction of some sort. And right now we're investing out of Fund 4, which is a $350 million fund. We invest globally, so we are 7 investing partners here in the US, Europe, and China. Before this, I was at NEA for 9 years, and there I did slightly earlier stage investing, but still up and down the stack. So I've been on everything from chip company boards, and there an MVP is $40 million in to get a chip out, and all the way to SaaS companies and consumer companies where you can get things off the ground pretty inexpensively. So really look forward to the conversation and all the questions from the audience today.
Excellent. Thank you so much, Rohini. Before the call, I was complimenting the beauty of her home, and she corrected me that it was the Museum of Art and Craft in San Francisco. Is that right?
Craft and design, yes. Yeah.
Craft and design. Wonderful, wonderful virtual background. Moving on, Mo, if you would do your introduction, and then we will wrap up the introductions with Andrew. Mo?
Sure. So, hey, everybody. Thank you for joining. I'm Mo Islam. I'm a general partner at Threshold Ventures. We are both a new and old firm. So we rebranded the firm about a year ago from DFJ. That firm has been around 35 years, early investors in a number of companies, SpaceX that we have with Chad, Tesla, Box, Skype, Twilio, et cetera. So we've been investing across consumer, enterprise, and what we call disruptive tech, if you will, but things that are more out in the frontier, which include space and autonomous vehicles and other things like that. I've been with the firm about 7 years. Before that, I was at InQtel, which, if you can believe it or not, the CIA has a strategic investment arm, and I was a technical staff member there. I am pretty sure I'm the only Mohammed Islam that's ever had a clearance held by the CIA. So that's something I like to say at cocktail parties, although we can't have them anymore. And we invest at the earliest stages at Threshold, so seed, Series A, Series B. So many times we're just investing on a team with an idea, and then for Series A or Series B, usually there's some sign of product market fit. And then we have our sister fund, DFJ Growth, that does the later stages, and sometimes we'll co-invest with them as well for companies that are a little bit in between for both of us. And yeah, it's been an exciting time right now. I would have told you, in Q1, things were not looking good, but, after we've gotten past the economic shock, it's been busier than ever, at least for the early stage VC market. A lot of activity, a lot of excitement. And so a lot of upcoming IPOs too for the companies that have gotten to growth stage and are now looking at public markets. So just it's a wild time right now. So super exciting time to start a company.
It's actually good to hear that optimism, Mo. I appreciate that because I think we can just hear the dismal, and I think it's good to hear a balance of that. Moving on, Andrew, if you could do your introduction, and then we'll get into more of the panel questions that I have before we open it up to the audience that's with us from around the globe.
Sure, thanks, and it's great to be here. So Andrew Romans, I started off as entrepreneur turned venture capitalist. I started a number of companies. First one when I was 24 years old that went on to raise over $100 million. I probably raised $250 million of VC funding. So I've been in the DFJ office pitching Tim Draper to no avail at like 10 different companies, although he wrote the foreword to my third book. So I've actually on MVP stuff, I really have started a bunch of companies with no money at all. And so I have a lot of experience about that. And I've written 3 books on venture, and the first one really talks a lot about how to make something out of nothing. So I love the topic. I then started something called the Founders Club, where I work closely with DFJ actually on that, with Beezer Clarkson on how to incentivize founders to help each other more. And so I created an equity exchange fund where you might be worth 500 million or 50 million on paper, but you're still paying student loans and can't afford to buy a house, and your kids have never been skiing. So I enable them to swap some of their equity with other founders that are backed by tier 1 VCs. And it made this insanely cool network. And then we took that and started a venture fund called Rubicon Venture Capital. And so a lot of these founders that knew each other and knew me decided, let's invest together and bring our network to support those companies. And we've had 2 funds, and we've rebranded and taken more of an international path with 7BC Venture Capital, which here at Engel is involved with. And we have a Silicon Valley fund that can do whatever it wants, invest globally. And we also have a Southeast Asia fund that only takes venture-backed companies and makes JVs where we execute fast. So rather than let the Samwer brothers copy you, own a massive chunk of your copycat and actually offload a ton of engineering to your copycat without any dilution to your cap table and going after markets with local teams. And we're doing the same thing in China. So rather than and I'll say this quick joke. Do you know what copyright means in Chinese? It means right to copy. And it's a joke, but they're going to do it. So you might as well own half of Didi. You might as well own half of Baidu, own half of Alibaba. And it brings tech there. It creates jobs. It creates tax revenue for them. So it's the finally honest way of working together. And it's insanely good for investors and founders. So I'll stop there.
Excellent. Excellent. Thank you all for being with us. Some of you got into this in your introduction, but not everybody did. And so I'd love to particularly start us off by talking about your investment thesis around minimum viable products, particularly around pre-revenue products. Now, Rohini, you talked about that you typically wait for proof of traction. But for the other investors, if you could talk, the other VCs, if you could talk a little bit around how do you analyze and make a decision about an MVP when it's pre-revenue? Andrew, do you want to start us off on that one?
Sure. Well, I'd say that different funds have different strategies. So, you've got at one point, Ron Conway at SV Angel was offering $150K on a convertible note to every single Y Combinator company without even going to demo day. You got Right Side Capital Management that'll have 300 companies in one portfolio, writing a ton of checks of 50K to 150, and that's what they do. And then you've got other funds that invest later. Right now with our fund, with 7BC, the earliest we'll invest is when they have 100K monthly reoccurring revenue. And then we call that late stage seed or pre-A. And 7%, being a little, colorful with the name 7BC and 7's lucky, is that it's also 7 continents, but to put 7% of our capital into pre-A. And originally pre-COVID, our plan was to invest in some totally pre-revenue companies. And some of the best investments I ever made, like Superhuman, are pre-revenue. But with COVID and with the LP community behaving the way it is, we're leaving it to 100K minimum MRR. So that's kind of 1.2 ARR. I think to answer your question specifically, maybe on behalf of myself, when I was doing the raw seed and others that do it, you're mainly investing in team. You want to see that there is team, that there's real technology, or at least a path and credibility to make the technology, and then a big market. So when Raul Vora, when I first met him, I was addicted to Reportive, his old company before. And so I like that. I invested in his cousin's company, who I just adore, him and his family. And then he told Raul, you got to make place for Andrew and his team because they have this insane network that'll help you. And Raul wanted our network to launch Superhuman. And I swear he had me at hello. Like, I shouldn't confess this, but within 30 seconds, I was like, rip all my clothes off, take anything you want, just grab anything off the walls, I'm in. So I think that happens sometimes, but I don't want to talk more about it because we're not seed investors right now, but it's hard not to. That's why we figure if 7% of the capital can go into like a Ron Conway portfolio where you're able to make a very fast decision and wire fast and bring friends into it, and then 93% of your fund is Series A and beyond, it allows us to feel comfortable making 25 seed investments a year.
Excellent, thanks. Chad or Mo, any response to that or distinction in terms of how you evaluate pre-revenue products?
Yeah, I'm happy to start, and then I'll hand it over to Chad. So a lot of that resonates, I would say, at a high level, team, technology, market, definitely things that we're looking at. Like I mentioned before, we're looking seed, Series A, Series B, so different sort of levels of product market fit. At some of the seed companies, it's not only pre-revenue, but also pre-product. And so a lot of the bet is on the team and their ability to kind of build whatever technology or product or service it may be. So we do spend a ton of time getting to know teams. We like to say we're a relationship-driven firm, and especially now with COVID, I think that's even in some ways become more important just because you can't meet people in person. And so all of the, I think the last 6 or 7 deals we've done, we've never met the founder before in person, which is a new thing. And so I would say a big part of it is the team. We don't have specific revenue metrics. I think if you're looking at an enterprise company that's at Series A, a lot of people will be looking for $1 million in annual recurring revenue. That's usually a staple a lot of folks will use. But at the very earliest stages, a lot of it is team. On the technology, we have to believe that this is the right team to build whatever technology or product that they're working on. So there has to be a belief that we have conviction that they can do that. And then on the market side, market is always interesting because I think a lot of times people underestimate how big the total addressable market can be. I mean, if you look at just the scale, a lot of the public cloud companies have gotten to, no one would have believed that 5 or 6 years ago. It's just incredible the scale they've gotten to, or even Tesla being a $400 billion company. We were an early investor. We had no kind of expectation that it would get that big. And so, TAM is the hardest thing I think sometimes to really wrap your head around. But we have to believe that there's a big enough opportunity there. I think generally for there to be a $1 billion business. Chad, on to you.
Yeah, you want to hear some more? Okay. Sure. So,
particularly Chad, anything that's different than we've heard already from Andrew and Mo and their approach?
Sure. I mean, so we take a slightly different approach. Well, a very specific approach. Ours is we take very concentrated bets. So while we're a seed stage investor, we're not, we'll invest in 15 to 20 companies in our fund and spend a lot of time with those companies. In our current fund, we have I think 65% of the companies that we've invested in, we've led, and we've joined the board. And I can tell you, one of those companies I've spent probably 30 hours a week with over the last 2 weeks. So we do get, we do get very involved and support where we can support. So I think that's an important distinction. And also, it's been said a couple of different ways already, but sort of high level, it's like the later stage you are, the more science you can apply to your evaluation. The earlier you are, it's more art. It's more of an art project. And so you're really, investing in the artist. And kind of that's how my brain works, and that's how I think about this. I think, JD, where you're trying to go with this is really, we invest in a lot of, like, the way we look at space is infrastructure, distribution, and application. And most of the opportunity is in the application front. And actually there's a lot of overlap with what Rohini was talking about. I was like, all of those things, I was like, yes, we're looking at all that stuff too, because it's like fundamentally driven by precision, GPS technologies. But on the infrastructure side as well, I mean, even if you get into this, the deep tech and the infrastructure side of space, at seed, you can still invest in something at a comparable sized round, at a comparable valuation with a minimum viable product, meaning that they've got something that sort of works, that is enough to show customers and generate some meaningful engagement with it, right? I'm not talking about a customer says, yeah, that'd be cool if that worked. It's more they're engaging, they're spending time with it. That could mean a lot of different things, and it could mean revenue, and that's and that's sometimes the case. But that they've got something enough to convince a customer to spend some meaningful time with that product, and you can get there because on the infrastructure side, particularly, there's a ton of non-dilutive capital that's available to founders. And honestly, those are the founders that we want to back, are the ones that are able to figure out what the landscape looks like, understand where the resources are, be able to pull all those together so that by the time they're coming and talking to us, they've got an MVP and some interested parties.
Jerry, can I add a couple of quick things to this as well? And
yes,
so
please. That's where I was going to go next.
Yeah, awesome. No, it was interesting that Mo mentioned that they're a team-driven, firm, and that's one thing that maybe that's an easy framework for founders to think about when they're talking to venture capitalists. People have a strong suit, so you have usually it's team, product, market, right? That's those are the three areas where that venture firms also have kind of a natural strong suit on that, or that's how they're organized and that's how they think about things. So in our case, for example, we are very market-oriented investors. So even though we can get fairly technical in terms of actually evaluating the products, ultimately we are looking at where are these markets going? What's the market thesis that's interesting? And sometimes that offers learnings that are global. So for example, in the ride sharing space that, Chad, we just was referring to as well, we saw, we're investors in Lime here, but even before we invested in Lime, we actually saw this happening in China first, right? Where there was ride sharing, and a market insight there was that the hardware cost is pretty much the same around the world, right? So whether it is here or in China, it's roughly the same. It's very transportable, but the price that you can get paid for a ride is very different in different markets. And you can micro-segment those markets, or you can say this is for commute, this is for tourism. So you can actually analyze markets differently. And so we looked at both the supply chain in China and to see how what the maturity was like, and then what is the application. So we invested in Lime here, and then later we went back and actually we've invested in a Chinese company called Songwo, which is in tier 5 markets. It's for a rural commute, which is different from an urban commute. So I think when you go and talk to firms, of course you want to you want to get your round done and be, and so on. But you should also kind of keep your ears open for how these firms think about it, because sometimes these are people who will be useful to you later on, or they may have insights of what is to come a little further down the line that could be useful for you. The second comment that I was going to make was on really separating revenue from, so there's pre-revenue and then there's pre-product. Pre-product is that it's really, somebody has come in with an idea, they have a great origin story, then they're telling you, I'm going to build this. And you have to look at them and say, okay, can this person really build it? Are they raising enough money to do something interesting? Whereas pre-revenue is a completely different way of thinking, right? So one of our companies that that was just acquired earlier this year is a company called Moovit, Moovit, which is like the Waze of public transit, and also Israeli company. And so when we invested, even though we think of ourselves as post-product and slightly later in the cycle, they did not have a single dollar of revenue yet, and they didn't even have actually a monetization model when we invested. What they did have was a great customer acquisition model. So entirely crowdsourced, very much like Waze. And so there are people who can still understand this. And the reason we got into it was because we were looking at the market again. So we knew sort of what worked in each market. So I would just kind of try to expand the the purview of what a minimum viable product looks like, and kind of separate the seed stage and from where the product is.
Excellent. I appreciate that. And just a little bit of procedural. If you're one of the audience members, pop questions that you have in the chat box, and we will be organizing those and figuring out a flow to ask those in. So just keep doing that for the panelists. Don't worry what's going into the chat box. We will we'll just keep the conversation going here. Rohini, I want to pick up on where you ended there and move to one of the questions that I had asked you all to think about. And that is, as a firm progresses both in size and scale and success, how does your view of MVP change? Do you end up having a higher threshold of what you expect as the firm grows, or do you find that you have a relationship, you understand the people, you understand the team, and that you are willing to give more latitude as they grow in size? So anybody want to step into that one first?
And here you're thinking about the venture firm itself, right? Or you sort of start with a particular model and your model changes. Is that the question?
As you look at the startups or the ventures that you're investing in, as they gain size, gain success, gain traction, how does your view of the MVP alter?
I can take a stab at it and then have other people opine. I think this is a super interesting question because the best entrepreneurs are constantly, of course, they're improving the product. So you find that you put out a product because it's better for you to put out a product to get people's real reactions rather than, you ask somebody what would they use, they'll tell you something completely different than what they'll actually do in real life. So it's better to put a product out there. And the best entrepreneurs tend to expand the hypothesis both on the product itself. Okay, this particular user uses this, I can add all of these other features and I can get better engagement and so on from this user. But they also look at adjacent markets and see kind of what else might happen. And then there is an interesting component of competition, like, so what else is happening in the market? And I'll give you an example, that's an interesting example from my NEA days. So we were investors in a company called Blue Jeans, which was it was the first, I guess, the first real video conferencing system. And they had like the most amazing pitch, right? Essentially at that point, everybody was used to audio conferences. Anybody who had worked at a company had used an audio conference bridge. And their pitch was, we do a video conference bridge. You can come in through Skype, you can come in through a video conferencing system, whatever you want to do, we'll give you a bridge. And it was a great elevator pitch, 5 minutes. The entrepreneurs are fantastic. They had built a company, sold it to Cisco before. They knew how to build product. They built the product. And they got from there to about 30 million in revenue. Essentially, it was sort of like all up rounds, very clean. It was very, it was sort of the standard startup story, except that the market completely changed on them. So they were in the conference room, bridging market, or that was the video conferencing market. And when Zoom came out, Zoom was essentially, first of all, they had a much better product, much different product, and it wasn't intended to be in conference room at all, right? It was just completely out of the conference room. They didn't care about telepresence and life size and all these systems that they didn't have to deal with at that initial stage. And then they came back into the conference room market. And, today you use, Zoom's a $70 billion company, and Blue Jeans got acquired for 400 million. That was still a good company. I mean, it's, and they're still fantastic entrepreneurs. But I think this whole idea of what is a viable product, you have to separate the minimum and you have to separate the viable from the product, I think, in that term. Yeah, but I think that changes because, how you define the market, what your competition does, and also what new technologies become available that make things easy. Like, when Blue Jeans started, nobody expected you would be doing this much video conferencing on a little mobile phone. So it's also sort of market timing that's involved in there.
Excellent. Thank you for that illustration. Any of the gentlemen want to offer your perspective on how MVP changes, or looking at M separate from V, separate from P?
Yeah, I thought that was great by Rohini. Similar kind of thought process for me in terms of, I think product market fit is just it's a journey, really. Even if if you have a minimum viable product and you're starting to see early signs of product market fit, it's a continuous sort of journey, because we've had companies that have gone from 1 million ARR to 10, and then slowly start to asymptote because they can't break through from there. And so it's something super difficult because it's something you continuously have to focus on. Do you get into adjacent markets? Something very common, for example, for a lot of our enterprise companies, is you start selling to SMBs or startups or what have you, and then how do you move up market over time to get access to bigger types of contracts, bigger types of customers. And so it's something, it's sort of continuous. It doesn't stop. Even if you have an MVP, you raise your seed round, you raise your Series A, it keeps going even to later growth stages, because there's always competition. There's market forces, like what Rohini was talking about. Market timing plays a big role, right? In terms of companies that got started too early or haven't adapted to changes in technology or changes that are happening on the macroeconomic side. So it's something that has to be continuous even after you get past the MVP. There have been, if you look at some of the companies in our portfolio, there was the one I mentioned earlier, which was a great enterprise SaaS company raised from top tier VCs sort of after us as well, and got to growth stage 10 million. Typically, growth stage firms, if it's like an enterprise company, will look for companies that are 10 million in annual recurring revenue, and then just couldn't really go past that point, and we ended up selling the company. Still a great outcome for us and the founder, sort of like what Rohini was mentioning with Blue Jeans, but didn't get to the big sort of billion-dollar, multi-billion-dollar outcome that some of the others have. And so it's something I think founders in some ways and the board members have to be a little bit paranoid about, and have to be continuously pushing, because it just doesn't stop after you get to MVP.
Yeah, JD, I'd like to add something to this, which is we look at some of the companies, they have a minimum viable product, and then they launch that, and they then fail to interact with their initial customers and users. And then they fail to understand, they fail to even onboard them in a way that they're trained in using it. Some products that are the most interesting are true forklift change of behavior products. And sometimes I worry, will people really change their behavior to use this and do things a different way? And I think I mentioned Superhuman again, but I've been speaking to Raul Vora about it, that I think one of the interesting things that Superhuman is giving all of us is teaching us how to truly onboard your first customers and make sure that they truly use the product and get all the value out of it. It's kind of like when you meet people that work at Google, they're wizards on how to connect all this Google stuff. And I barely get below the tip of the iceberg on how to use all that Google stuff. And I wish I worked at Google just so for the rest of my life, I would know how to be like an Apple genius and all that. But with the minimal viable product, what Raul did, which is so genius, is that they onboard each person with like a 30, 60-minute session, and they collect all this feedback continuously from the users so that they really don't have any churn and they truly fine-tune the product. It's a bit like one great tactic for creating something out of nothing is forget all these VCs, forget all these angels to say, come back when you've got like quarterly EBITDA or 100K MRR. Just get a customer and custom build your product for what they want and let them pay you. And then, you know, bootstrap your business with revenue and do it. So as you were talking about how do we view a changing MVP, that a key thing is to truly communicate really well with your early users and make sure you don't lose them, or understand a subset of your users. Don't pay attention to all the noise from your users, but figure out which ones to pay attention to and migrate that MVP into something that becomes a real business.
Excellent, thanks. Chad, anything distinct, or can I move to the next question here?
Up to you. I can do either.
You know what? We're starting to get a lot of questions from the audience. So let me move there,
Sure.
and I'm going to let you be the first one to answer it. And the other, we don't have to hear from all four on every single question, but I want to be sure we get different perspectives that we can debate or learn from. Harold asked the question: could you address your stand on solo entrepreneurs, building a team versus having formal co-founders? He cites a study in Inc. magazine by Wharton, which I think is still a business school on the East Coast, might be somewhere in Pennsylvania. Anyway, the Wharton study showing that entrepreneurs who start a business on their own are likelier to succeed than those who do so with one or more partners. So Chad, how do you look at partnership versus solopreneurs? And then I'll hear from any of the other team members before we go to the next audience question.
Yeah, that feels like a really dangerous thing to make a universal sort of statement about. There's a lot of variables, I think, that would go into the success or failure on both sides of that coin. I mean, it sort of depends on the entrepreneur, and it depends, it depends on the founding team. And these are kind of things that you would have to decide for yourself, and that we would have to evaluate coming in, and it would be definitely on a case by case. But the thing that stands out to me is I often see, particularly like we invest globally, and this often happens in Europe, is there will be a founding team. It'll probably be too large, like there's 4 or 5 of them, and they've all decided to split the equity. Everyone gets 20%. And you're like, why did you do that? Walk me through the thought process. Well, we all kind of, did this together, was all our idea, and that sort of thing. And that is 100% never the case, that everyone's putting in 20% of the work. So every time that you see something like that happen, then you can already start to see that there's going to be some trouble here. There's like, anytime that you see a company with a co-CEO or a CEO and like some other title that's, executive chairman or something like that, there's trouble, right? If there's not a clear sort of chain of command, if there's not one decision maker that like the buck stops here, then there's some clear issues there. And if there's not now, there will be later when things start to get more intense and more involved. So I'm running through the list of our portfolio companies. We have probably the most successful ones are the ones with a very strong CEO and all types of backgrounds and all types of experience, but one really strong CEO that's able to bring a really great team around them to help them fill in the gaps that they might have in their experience, or the ones that I see where there's trouble is when they try to use when they feel like there's a crutch for them, and I think that kind of, you can start to see the smoke there when people are equally sharing equity, because in the end of the day, you need that person that has the motivation and is compensated in equity in a way that keeps them up, at night and wants to do the job. So, sorry, so not a direct, sort of like universal answer there, but some clues and things that we look out for, I think.
Excellent. Andrew, your thoughts on solo versus team, and is there a route that's more successful?
I think that there's different ways to get up the mountain, and so solo founder can work very, very well. Two can work really well. It's actually Stanford is the one that produces the most co-CEOs, and it annoys the hell out of me too. Like, it's just not going to work, and so I have to talk them out of it. Like, go home, come back when you figured out who we can call CEO, and then they're like, oh, titles don't matter. Dude, titles matter so much. And once that one guy is CEO, the others will be like, we should never have done it. They do group work. I mean, I got an MBA at Georgetown. Group work sucks, but it's the best thing to ever happen to you when it's over. So they do the group work at Stanford, and then they come out and say, well, there's no way I'm letting you own more or be the CEO, co-CEOs. But as Chad said, it's got to be a military chain of command. Now, the funny thing is that the LPs try to impose Stanford group work on benchmark. Let's all be equal GPs, consensus on every decision. Like Steve Jobs said, there's no art by design by committee. Yeah, design by committee. You ever like say, everyone get a bottle, we're going to make a painting together? You got to burn that thing afterwards. It looks horrible. So I always laugh about, like, people hate, we all have to have, you have to be like Stanford 3-way, 5-way co-CEOs at benchmark, although we don't tolerate it at our portfolio companies. Yeah. But it comes down to like Mission Impossible, the old TV show before Tom Cruise kind of ruined it. The beginning of the show is that he looks at the people and he's like, all right, I got my like explosive expert. I got my woman who can speak with a Berlinish German accent, whatever. And that team can accomplish the impossible mission. It's the same thing with startups. You need a team that can accomplish that impossible mission. And there's a bit of yin yang of, this is the introvert genius. This is the extrovert salesperson. This is the one who knows the industry. And you got to put that team together. If one person walks into your office, one woman walks into your office and says, I'm a solo founder, but I come from this industry and I have my Mission Impossible people to bring in, and I can convince you that I can make this technology because I made that technology before. You can say, all right, we can fully populate the management team and pull down this impossible mission and storm the castle. If a team of like 5 people come in and say, yeah, I'm the explosive expert, I'm the one who speaks German, I'm the one who knows the market, then you're like, enough said, we have a fully populated management team. Let's look at the cap table and maybe put you guys on, founder vesting shares. So if one of you breaks up and has a divorce with the rest of you, we don't have too much dead weight in the cap table. So different ways can work, but you need to be convinced that we can fill in the missing bits together.
Yeah, got it. So let's be clear though, the reason Stanford does so many group projects is because it's easier for a professor to grade 12 projects than it is to grade 72. So that's why we do a lot of group work at Stanford. So Rohini, your thoughts on the question versus solo versus team, and then I'm gonna flip the tables and look at how entrepreneurs should decide which VCs they go to. But your thoughts on solo versus team?
Yeah, I mean, lots of good points there from Andrew and Chad. So it is case by case, and it depends on sort of where you're building it. Maybe some other hooks that you can think about is, typically if this is a business model innovation, right, where you know an industry and you're kind of turning it around, you may be able to pull it off being a solo entrepreneur, and you have this visionary who's going to build it no matter what, and people will say, okay, yeah, I can get behind this person and do that. Where I think it becomes very challenging is that once you start building a product, especially if you can't build the product yourself, and most interesting products are a team problem solve right now, it's really hard to hire the first employee. Right? Most, if somebody is good enough, they want to go be a founder themselves. You might get much better quality people on your team if you're willing to have a founding team versus saying, I want to hire you to be my employee, right? And I think that especially with a lot of technology centric ideas, that becomes one of the bottlenecks, because there might be a 10x difference in the value between someone who comes in as a founder versus who comes in as an employee and wants to be trained on the job, right? So, and if you don't know how to build it and they don't know how to build it, like this project is not going to go anywhere, right? So you kind of need to, you need to have somebody who knows how to do this. So those are a couple of things that I would encourage people to think about. We, on the comment about the founder equity, I do encourage people to be generous with founder equity. And we had a company at NEA where there were two founders who were still leaving VMware to go start this company. And so they were the first two founders. And there was a lot of this, angst about where does the IP stay? So you can't do too much work before you leave your previous employer, do this, all of that. But they did need to get this off the ground. They actually left a pocket of founder equity because they knew, like, once they stepped out from this company, that they would want to have one other founder or maybe even two other founders. And there was a pocket of founder equity. So it's the opposite of, what Andrew was saying, because it is really important that the founder equity both reward somebody's current value as well as somebody's future value. And so in their case, they figured that if I have this founder equity available, I can hire a much better, storage system expert than if I didn't have founder equity available. So those are some things to think about.
That's a great illustration, and I just want to compliment all four of the panelists. The stories are so helpful because that really illustrates the point that you're making. We're not going to get to all the questions that the audience is posing, but the next one that I want to look at came in from Sahil, and this is flipping the table. And Mo, I'm going to start with you on this one. From a founder's perspective, let me go back to it here. The question just left me. From a founder's perspective, what are some of the key points that founders need to look for when they're deciding on investors, particularly at a seed stage? What are some of the factors, apart from just money and vision and values and network, that they should look at? Now, Sahil notes that possibly overthinking it, but what should they be considering as they're deciding who to approach? Mo, you want to start us out?
Yeah, no, it's a great question. I think something all founders should be thinking about. I think a lot of it, going back to what I was saying before about relationships, especially if this is someone who potentially is going to be on your board, and that's a long-term relationship. We sort of describe it as founder dating with investors, where you really want to get to know a person, especially if they're going to be a lead investor, which we typically are when we invest. and join the board, because that, can be a 10, 15-year journey, which unfortunately is longer than some marriages, right? And so it is a very long process.
That's scary, but you're right.
Yeah, unfortunately, right? Or at least that's what my wife tells me. Now, I think, there's a lot of capital right now. There's a ton of venture firms, I think more so than ever, just in terms of pre-seed, seed firms that I know. And so I think for founders, there's a lot of availability, which is great. But I think, building a relationship with a specific partner at a firm, one who is aligned with your vision for the company and how you want to build it, is going to be really important. And I think it's good to have those frank conversations very early. And one that you think has some of the other stuff you talked about in terms of network, value add. Every VC claims they have value add with their network, or helping you with marketing, or helping you with talent, or helping you with business development. But I think ultimately it comes down to the relationship, and is this someone you think you want to work with for 10 years? Because it is, especially starting at the seed stage, it is a very long journey.
Can I just give a short answer to this?
Yes, please, Andrew.
A short answer I'd say is look at the reputation of the fund. So, I mean, if you hated everyone at Stanford, but at Stanford, you should consider that rather than Alabama State, which, you like the people more maybe. So reputation of the fund, there's economics, depending on where you are in your journey, what are the economics of the term sheet? And then there's the chemistry with the partner who's leading the deal. And be careful about listening to the campaign promises of VCs of all the value that they're going to deliver, because it often doesn't come. And then a fourth point is just take the money. Like, if somebody's offering you money, like a number one cause of death of startups is running out of cash. And I think one of the number one problems, like negative characteristics that entrepreneurs have, is they put too much weight in the decision-making equation on dilution, and they may be even raising at a higher valuation than they should. The Valley often gets this right, but in like Europe and more provincial ecosystems, they go for the biggest valuation they can, and then their next round is struggling to even be flat, not to mention going down.
Thanks for that, Andrew. We've only got about 8 minutes left, so I'm going to go to one more question from the audience and then have each of you give a final closing statement. Earlier, a couple of you mentioned how COVID has affected your business. Mo, you mentioned that you've actually now invested in companies without ever meeting the founder in person. I'm curious, from any of the four of you, I'll let whoever wants to jump into it first, but how has the current shelter-in-place environment, reaction to COVID, impacted your investing, particularly in MVPs, for the positive or for the negative? What has been the impact? Chad, you want to start us out?
Sure. So we are a small fund. We've got 5 people on our team. I'm based in New York, and the team's based here in New York. My partner is based in LA. And we do that on purpose because for time zones. So because we invest globally, and most of the activity in what we're looking at is in the West Coast of the US to Europe, this gives us really good coverage. So, we've been remote first from the beginning. And we had, oftentimes we've invested in founders without meeting them in person. And we're having conversations with, companies now about they're making key hires with people they've never met before. And how do you overcome that? And you do it with more meetings, with videos, more reference calls. We're having way more, for these key positions, especially, we're having way more conversations than we normally would have, spread out over time. And you rely on your network and relationships a lot more. So the way that we did this is, we've got really great funds that we have good relationships with, that we work with in other geographies. and they feed us deals, we do deals together, and then we're able to assess the founder based on, you know, our collective sort of mutual understanding. So yeah, so we've made, you know, we've been doing this, you know, since our founding, and so I think it's great that, you know, everyone's congratulating themselves on Twitter and saying that we. No offense, Phil. This is not directed at you, but it's just kind of funny, you know, to see people doing this now. It's like, you know, we've been doing it, but it's interesting to like work through the challenges. You know, like for me, the biggest one has been key hires on teams. You know, like that's a hard one to overcome. And so working with founders and trying to figure out the best way to do that has been the bigger challenge.
Excellent. Anyone else from the panel, reflection on COVID?
I would say that, oh, go ahead.
Yeah, so maybe quickly, yeah, so like Chad, we've also been remote. As I mentioned, we are 7 partners, and so our investing teams are here in China, in Europe, and that is actually one of the things where our days are pretty long, actually. It shouldn't be. So if you don't want to have a long day, you need to learn how to work asynchronously, and so we've learned to work asynchronously that way. I do think that, so because we've had a portfolio that was pretty heavily in smart mobility, that was our, like, so we were quite challenged, I would say, in March and April. We've had companies where revenue went from, you know, 100 million plus to nearly zero overnight. And so then you have to look at the company you're in again. You're looking at it as an MVP again, you know, so the market has completely changed. Do we still keep going? How do we keep going? How do we finance this? So we had to do that with a big part of our smart mobility portfolio. On the other hand, they've also had the biggest spikes. So, you know, they've like if you're in grocery delivery or if you're in other forms of logistics, remote has been great. And similarly with enterprise, I think remote everything has been great. So yes, we have had to adapt a little bit, but we had I think had a good substrate. But in terms of our investing practice, it has meant that we've had to think about things from first principles for, you know, a good, you know, 30% of our portfolio.
Excellent. Thanks, Rohini. Andrew, you had a thought.
Yeah, I think I think everyone should adopt a similar view that we got to get through these next 6 months, 12 months, 18, 36 months. And it's uncertain when, you know, things would begin to return to normal. And it seems clear that just like the Great Depression had a lasting effect on generations, people are going to be more remote. Jack Dorsey saying you can live anywhere. So we are, I think that I get annoyed as hell when I on these Zoom calls with other VCs saying, we just can't invest over Zoom. We have to Larry David look you in the eyes. And similar to Chad, we've had a New York office for the last 10 years. You know, Josh and I, one of us would meet the entrepreneur and the other one's doing it over Zoom. And so we've been crazy pushing for video. And I've been traveling more than 50% of the time before COVID all over the world, raising money mostly. And to get these, finally, people in Saudi are willing to Zoom with me. It's amazing for me. So I almost, you know, I think we just got to get over it and invest over Zoom and start doing it. And if you're an entrepreneur and you hear that the guy just will not invest over Zoom, that's a problem. Also, we're in a period of, you know, social injustice of, you know, the police murdering people of color and stuff. And if we only, this is like the worst time to say, I'll only invest in a deal where another white man knows, has met him. And it'll just make it even more of an insulated circle if you head in that direction. So, you know, you've got to just do the work and like start talking to people while you're walking your dog and, you know, get to know these people somehow without meeting them in person. There's face-to-faces happening in the Valley now, you know, where it's like, it's not in Sand Hill Road, it's more of like in an outdoor restaurant or something.
Right. Excellent. Thank you all. That was not one I had prepped, but as we started the conversation, I really don't think we could have not taken a moment to look at that. So speed round, you each get one final thought. And the question I have is, what's the one piece of advice you would like to give the current Stanford Rebuild Program and Lisa cohort. And it may be a piece of advice you didn't get to put into an answer earlier because I cut you off or I moved on to somebody else. But what would you like your closing thought to be around today's conversation for the participants in the room? And I'm going to start with Mo, then Chad, Andrew, and Rohini. You get the very last word. So Mo.
Yeah, I just want to say, great panel and great audience questions. Thanks so much. We talked about MVP, product market fit, team compositions. The one thing I think I'll leave folks with is, especially as you're working on whatever product you're building and you're going to go talk to investors, really think about the narrative. A lot of what really sells investors, especially early on, we talked about team, technology, and market, but it's also just the story that you tell, because people have to buy into what you're building now, but then what it's going to look like 5 or 10 years from now when it becomes, a much bigger thing. And so it's surprising to me, but I think it's one of the most important things for founders to really focus on is, telling a story that not only you find compelling, but others are going to find compelling as well. And really focusing on that in terms of when you pitch investors, when you pitch customers, when you pitch, employees to join you, that narrative is going to be important kind of going forward. So it's really worth thinking about that, because that's something we definitely look for, is the clarity of thought around that. And so it's worth taking time doing that.
Excellent. And moving on to Chad, what's your final piece of advice?
I would just say that when we're talking about seed and MVP stage, we're early and team is paramount. And so resourcefulness is probably the most important thing that I'm looking for in folks that come to me, because if you're able to do a lot with very little or nothing, and you're able to come and show me that, look at what I've been able to do with no money, imagine what I could do with some funding, that's where I want to be. So, and that comes with, I saw some questions in the chat earlier about how do you get a meeting, that sort of thing. It's about working it, finding connections, doing whatever you can to make it happen, pull those disparate network nodes together, figure out how to make, get yourself to MVP without capital. If you're able to do that, you've made a pretty strong case for yourself.
Awesome. Thank you so much. Andrew, final piece of advice.
And I'll answer some of the questions I saw coming in on the chat too. Again, number one cause of death is running out of money, running out of cash. And so you've got control over your expenses. You can get revenue in, and you can get investor money in. So these are the three things to really keep your eye on. I think that what this audience is that we're all part of the Stanford University community. And so what to do when you have no money and no revenue and you're very, very early is find one person from the Stanford community that believes in you, that you have a relationship with, and try to tell them, we're going to build a board of advisors with 3 to 5 people. And I want you to be the first person to be on the advisory board. And your first job, your first task is to recruit another advisor to bring in. And you want to get advisors that have, a balanced scorecard of skills, like back to the Mission Impossible. One will be someone who knows all the pre-seed, seed, early stage VCs. And so you get that person involved, and you can give 5% of the cap table to the advisory board. If it's too small, they'll do nothing and you've lost equity. If it's too much, you have potentially dead weight. Try to get them to give you something. $5,000, $10,000. Come on, man, you invented the internet. Why don't you give me something, right? And then I can say I've raised money from Mr. Big, Mrs. Big. And now you actually have a little bit of money. And now they've got money in. They're more interested in that working than they are in the 1.5% of the company you gave them. So sometimes that is a little bit of generosity can pay back, big. And now you're beginning to have not just the team, but a community of network around that startup that really makes stuff happen, not just funding, but customers and team and everything. I'll stop there.
Excellent. Thank you. Rohini, what would you leave us with?
Yeah, well, I think, you know, venture investors like to say there's no bad time to start a company. But I think it's especially true right now. I think, you know, the world is full of new problems. And I think the way we get out of some of the problems we are in right now, we didn't talk a lot about COVID and health and so on, because I think we self-selected to be more tech investors here. But I do think that the world is full of big problems right now, and the way we get out of it is by collective ingenuity. And I think all of the work that you guys are doing and looking for interesting things to work on and problems to solve and find that mission for the next 10 years, find that group of people for the next 10 years, next 15 years. I think what you're doing is super important, and you know, nobody else is coming to save us. We have to save ourselves. So, you know, I think you guys are a big part of how we get out of the mess we're in. So keep doing it. Keep your motivation up. Take care of yourselves. Be kind to yourselves, and march the long march.
Awesome. That is a great note for us to end on. I just want to synthesize the power and value of narration, clear narrative, resourcefulness, generosity, and collective ingenuity. I want to thank all four of the panelists for just being generous with your stories, with your narrative and your insights. We couldn't get to everything that people had questions about, but we had a rich conversation this Thursday morning. So really want to acknowledge and thank you.